Hello, and welcome to Portfolio Matters, weekly checklist, week 126. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Thank you very much, Richard. We have, first of all, the news. So the great news is that UK inflation finally came in soft, i.e. below expectations, at 7.9% year on year in June, which was well down on 8.7% in May. But the best thing was that it's just below expectations. So finally, inflation is missing expectations rather than beating them. Core CPI fell to 6.9% from 7.1%. Bottom line, UK inflation is still way too high, but is now coming down. Interest rate expectations fell and bonds rallied. All good news. In Europe, we have had a huge heat wave that has seen wildfires in Greece, as per our picture this week, and temperatures in Sardinia hit 47 degrees C. Wheat prices had a volatile week, but ended the week strongly up after Russia refused to renew the Black Sea export deal and warned that all Ukrainian vessels would be treated as if they were carrying arms. And Chinese high-yield dollar bonds continue to plunge after a state-backed building developer, Greenland Holdings, defaulted on its 6.75% bonds. Some charts. Well, the great news is that UK interest rate expectations appear to have peaked. And if you back out the market's implied interest rates for the UK, a few weeks ago they were at 6.5%. Now the peak is expected at 5.8%. Next week it's the FOMC meeting, and the market is pricing in a 99.2% chance they're going to raise. This is the global average temperature, and it continues to hit new highs, although you wouldn't know that from watching the cricket. And the US dollar has had an incredibly poor run over the last few weeks, hitting new lows, although they did bounce a bit towards the end of this week. If you look at the twin deficits, that's the current account and the fiscal deficit, then as a percentage of GDP, they are really poor. Actually, they're at levels only seen at the depths of the great financial crisis. So the US is borrowing a lot of money, both from bondholders and from overseas, and that explains the weakness of the dollar. And it is only 6 weeks since the US debt ceiling bill was passed, and in those 6 weeks, the US federal debt has risen by $1 trillion. We have more on that later. And these are wheat prices, which spiked after the end of the export deal. Although, if you look at what Ukraine actually exports, it's 50% corn, only 27% wheat. Okay, and on to this week's economic data. Richard.
So here we have UK month-on-month CPI. As Keith has said, it was lower than expectations. And finally, surprising on the downside, which is good news. And hopefully the start of a trend of our inflation dropping quite quickly, catching up with the drops in Europe and the US.
Yeah, and this was actually quite a big miss, really good. So June number was only 0.1% month on month, expected at 0.4.
This is the year on year, where it has dropped to a miserly 8%. I don't know what happens to RPI. Of course, there's a stronger pound at the moment as well, which is possibly feeding into the price of imports. And UK core CPI also down, and significantly down against expectations. So the entirety of the inflation universe in the UK is dropping faster than expected. Well, to be fair, it rose faster than expected for quite a long time. UK core CPI year on year, around about 7%, so hopefully levelling off, really. I think it's looking at that chart, it's the best we can say at the moment. And there's the RPI, which having hit the ghastly heights of 14%, is now at 10.7% and significantly better than expectations. UK input PPI is now in negative territory and significantly lower than people were expecting. Again, that could be due to imports and the strength of the pound. Not quite sure how quickly that effect feeds through. UK output PPI year on year is effectively zero, which is very good news for the prospects of future inflation. And UK core output PPI around about 3%, and that's a little bit higher than expectations. And but again, it has fallen very, very sharply in the last few months, and that is good news for UK inflation.
Yeah, but you notice that core output is substantially higher than input. So does that suggest that UK manufacturers are taking advantage of the fall in input prices to increase margins and not passing all the fall in inflation on to consumers?
It depends what their stock holding time is, I guess.
Yeah. But you notice it missed expectations, Richard.
Yes.
The only one to miss expectations.
Yeah. Well, you may well be right, Keith. And the UK consumer confidence index is worse than expected at -30. And it is on actually, consumer confidence in the UK hasn't been good since 2015. And basically, it is national depression is setting in by the look of it.
Yeah. I wonder what happened then, Richard. 2016.
What happened then, Keith?
Brexit, mate.
Oh, God, sorry. Oh, yeah.
Yeah.
That's an interesting point, Keith. UK retail sales month on month, better than expected, quite significantly better than expected. So the UK economy perking up a bit.
Yeah, the commentary was that was partly due to the good weather. We'll see.
Yeah. Well, you do expect good weather in the summer, of course. UK retail sales, I mean, we are in the UK, so maybe we don't expect good weather in the summer, but UK retail sales year on year, I mean, they're just sort of just around about zero, aren't they? And slightly better, but they haven't been particularly good for a couple of years. And divergence between retail volumes and values, of course, this is the effect of inflation since June 2021. Significant inflation, so value's gone up, the volume's gone down and now leveled off. Then significantly higher prices being paid.
This is interesting. If you look at what UK consumers have been spending on, you'll see the dark blue line, which they're spending on staples, i.e. food, drink, and that modern essential communication has been stable. And so what they've done is they've cut back on clothing, footwear, furnishing, equipment, and recreation, actually quite hard. That's probably about a 30% drop, and a bit on social. So they've delayed spending on big items, be it durable goods, etc.
It's interesting. Here's the UK public sector borrowing requirement, which is significantly better. Apparently tax receipts were much higher than expected. So that is a lot better than expectations. It's still not good.
Yeah, it's still not good.
And here we have EU construction output year on year, which is basically not growing, but not in recession either. EU consumer confidence is up, but it's not good.
Yeah, actually it's surprising, because what we know about the EU economy and the fact that, for example, retail sales are doing very poorly. But they're feeling better. As I take it, that is in part due to the fall in food and energy inflation.
Yeah. Also wonder how they measure it, whether people just feel better if the weather's nice or their football team has just won or something like that.
Good point. Although all their football teams can't win, Richard.
Very true, Keith.
Before we carry on, actually, I should point out that in the edit last week, it became clear that the live feed of our faces overlaid some of the data. So I've rearranged things and you will see. So you now have just 2 months data showing, and those 2 months change. So you now have to read those to see which months the data refer to. So US import prices came in well below expectations and down a massive 6% year on year in the US. Export prices, I thought this was absolutely shocking. Export prices have fallen 12% year on year. What on earth are the Americans exporting?
Is it oil? Fossil fuels?
I think it must be. Well, they do export that, but that's only a small part of their exports. I suspect it's tech, and we know online prices have been falling.
Yeah, it's a chunky drop, Keith. Whatever it is,
it is a big drop, but it shows deflationary forces are building.
Yeah.
Now we had the US Michigan Consumer Survey, and the headline index rose quite sharply to 72.6, well ahead of expectations, and shows that the US consumer is actually feeling more confident about life as we go through the year, and that bodes well for the second half. The bad news was that with that renewed confidence came higher inflation expectations. So their 1 year expectations ticked up to 3.4%. The Fed won't be happy. And the 5 year also ticked up to 3.1%. So that's probably behind the market pricing in a 99.2% that the Fed raises interest rates this week. And their current conditions index massively jumped up from 69 last week, up from 69 last month to 77.5 in July. Surprising. You do wonder, I wonder, how much of this is due to the fact the Nasdaq's going through the roof. And the economy is increasingly linked to the market, or certainly the sentiment of consumers appears to be. Retail sales, though, were disappointing. Expected 0.5% month on month, grew at 0.2%, although the figures for May were revised upwards. Year on year, growing at 1.5%, again missing expectations. Industrial production, it was expected to stabilize. It kept on falling, down another 0.5% month on month. US manufacturing is in recession. It's not doing well. Year on year, big miss, down 0.4% year on year. Business inventories continue to grow, so there is nothing to suggest businesses will be reordering anytime soon, although retail inventories have been falling recently. So at some stage, retailers will need to restock, but you'll notice the falls have been absolutely trivial. Meanwhile, the US housing market continues to defy expectations, ticking up very slightly, meeting expectations, but the Conference Board leading indicator fell again in June, below expectations, down on May. Although if you look at the coincident indicator and the leading indicator, that is a huge gap. Now, when that has happened before, the leading indicator has been right, and the coincident indicator then tends to follow it down, but that is a big gap. Now, what I found really interesting is if you look at the components of the leading indicator, see, pretty much everything is negative. New orders, negative. Consumer expectations, negative. Interest rate spread, negative. The only thing that's positive is the S&P 500. So the performance of the stock market is keeping confidence up. If that were to fall over, Richard.
The last shoe to drop, Keith.
Yeah. Now, the Empire State Manufacturing Index fell in July from June, but was above expectations and still in expansion territory. The Philadelphia Fed Manufacturing Index was worse than expectations, although a tiny bit better than June. Johnson Redbook retail sales, reminder, this is year-on-year comparisons of same-store sales in nominal terms, not real, were down 0.2%. Building permits fell sharply in June, although, frankly, if you look at the absolute number, that looks absolutely fine. Housing starts fell sharply, but again, if you look at the absolute number, that looks fine.
So I read this week that the sale of existing homes in the US has virtually ground to a halt.
Yeah, the problem for the US housing is that people with existing homes have mortgages they took out when interest rates were much lower, so they just don't want to sell. Although, and we'll discuss this next week, actually about 40% of US homes are owned outright, and they could sell, but they're just choosing not to. So the very low inventory levels are partly a function of confidence. The US MBA 30-year mortgage rate fell slightly, but is still pretty much at 7%. And the mortgage market index is dead. As Richard was just saying, very few people are taking out mortgages to buy homes. Initial jobless claims fell. Continuing jobless claims ticked up a bit. But there are strong seasonal adjustments. We've talked about this before, and Richard is very skeptical about seasonal adjustments. And actually, if you just look at the raw data, I think you get a much better picture. So the black line is the average between 2022, 2019, and 2018. The red line is the average 2019, 2018. The blue line is now. Clearly, continuing claims are ticking up.
This is a much more useful data series, isn't it, Keith? Because you can actually draw your own conclusions. And that is a very, very steep increase.
Yeah. And you'll notice at the start of the year, it was well below.
Yeah.
It's now moved to well above. Yeah. The US labor market is slowing, although you might not read that from the charts, the seasonally adjusted charts.
Be interested to see what happens over the next few weeks to that, if it continues its upwards trajectory.
Yeah. Well, we'll keep you informed. Okay, on to China. Very disappointing numbers. So Q2 GDP growth came in slightly above expectations, but only at 0.8% quarter on quarter. And that is well below their 5% GDP growth target. So, and the year-on-year number was 6.3%, below expectations. Fixed asset investment was better than expected, but drifting down. You see it's been drifting steadily down over time. Industrial production actually was okay. Came in at 4.4% year on year in June, up on May, and well above expectations. Although data from China should always be treated with a touch of skepticism, I would say.
Yeah.
As that seems to contradict a lot of the other stuff we're seeing.
Just what I was thinking, Keith.
Retail sales, that frankly is a shocking drop. Remember, this is the year-on-year number. So in May, it was up 12.7% year-on-year. 1 month later, it's only 3.1%. That implies either that there was incredibly strong retail growth last June that's now dropped out of the window, or this June saw a big drop in Chinese retail sales. So in summary, UK, great news. Inflation came in softer than expected and frankly seems well set to continue falling. Retail sales were strong in June, although that might be due to good weather. But UK consumers' confidence fell sharply as higher interest rates began to take their toll, and they will take an increasing toll over the coming months. And reminder, the Bank of England is still raising rates. In the EU, we had construction output, which is pathetic, but still above zero. And consumer confidence recovered slightly, but is still very poor. In the US, we had consumer confidence numbers, which showed a decent recovery in July, actually surprisingly strong. But contradicting that, June retail sales fell to 0.2% month on month, and the May numbers were revised down, and the Johnson Red Book number was negative year on year for the second week. So despite rising US consumer confidence, they appear to be increasingly financially stretched. Industrial production was poor, and the manufacturing sector does not look good. The leading index fell again. So although the US economy continues to be resilient, the outlook from the leading indicators continues to forecast a coming recession. Finally, China, growth in China is slowing. Okay, and on to one chart. Now, I thought this was interesting. Thank you very much to our Discord member, Jaw-It, for sending me this. So this is the growth of the S&P 500. And what you see is that although the advice is always just to stay invested, the stock market has had actually quite a number of extended periods when it's done nothing for a decade. And reminder, this is nominal. So when you look at the real return over those periods, then it would have been negative. And those periods of poor performance tend to come after the market has had a very strong run and got overvalued. And frankly, I think that's where we are now. So I'd be very cautious about equities. And the fact that equities have had a good few months, reminder, you're playing a long-term game.
Interesting chart, please.
Your thoughts, Richard?
Yes, interesting chart. Just looking at it because it's a logarithmic scale. So if you look at the last period of 1980 to 2000, the increase was from 1,000 to 10,000, which is tenfold. And the same was true of 1950 to 1970. But if you look at now, where it's 10,000 to about 24,000. So if it were to be tenfold, it will quadruple before we have a period of a decade or two of non-performance.
That's a very good point.
That is. I mean, I'm not saying that's going to happen, but it is, the disparities between the growth periods are really quite extraordinary. Not disparities, the size of the multiplication of the index. Yeah.
I mean, the one thing I'd say is that this particular bull run starts when the index is at.
But if you take it from the point at which it regains its previous high, so in 1983, where that's almost a tenfold increase. And also, if you do the same thing about 1948, you get almost a tenfold increase.
Okay, well, so Richard's saying it's got further to go.
Well, but also, of course, what you also have to understand when you're looking to interpreting this is what was the extent of overvaluation at the point that it regained its prior high. And I would argue that by the time you got to 2014, we already had an overvalued market.
Yeah. Well, I would also say that, the profitability of the stock market is a function of productivity growth, which we know has been steadily declining.
Yeah, very good point, Keith. So don't base all of your investment on that chart. It's our general advice, but it's an interesting chart.
Yeah, no, well, absolutely. You can't, timing this is very difficult, but once the market starts falling, then it can stay down for quite a long time.
And I think that's the point to take away from it. It's the original point that they can not go anywhere, move sideways for a long period. So moving on to, have interest rate rises had any effect on the economy? So far, all of the fall in US inflation has been through the unwinding of supply shocks. So there's been a little reduction in inflation due to fall in demand. So the blue is demand-driven inflation, which has really been pretty constant since July, June, May 2021. We've got this sort of ambiguous area, which is moved a little bit, but supply-driven inflation has resulted in most of the increase and most of the decrease. And supply-driven inflation isn't really impacted by interest rates. So we know that supply-side bottlenecks have eased, and they were post-COVID, and inflation has eased along with those bottlenecks easing. So was the inflationary episode ever due to excess demand, or was it due to supply problems? So if the premise was that if the premise was wrong, that it was actually supply side problems, not demand, then the increase in interest rates was the wrong solution. But the Fed had no choice to raise interest rates, because it is the expected solution to combating inflation. And if the Fed hadn't raised interest rates, then inflation expectations could have become unanchored. And unanchored inflation expectations create the self-fulfilling prophecy, the vicious cycle. And the notion then would be the reduction that we're now seeing in inflation, the rapid reduction that we see in inflation, is primarily due to unwinding of supply shocks and not reduction in demand, which means that the higher interest rates have, while they have limited demand to an extent, they will have had some impact on demand. We know it's been small because of the transmission mechanism of interest rates. So the economy is very slow, with everybody having fixed rate mortgages. So the question being posed here and this is posed by Paul Krugman, is that has the Fed basically been following a policy that they didn't need to follow? Well, possibly, but hindsight is always an easy thing. And so I'm not a fan of the Fed, as everybody here probably knows, but cast your mind back to transitory inflation and how they were mocked for saying it was transitory, and they didn't raise interest rates, and then finally they did. Tough one, really, but I suspect that what Paul Krugman is saying may well have a basis in fact.
Well, the thing is, Richard, I think they had no choice. And I agree that it's had limited effect. And everyone, including me, have underestimated the lag effects. But the point was, they had to do it because that's what everyone expected them to do. And if they hadn't done it, then I think the secondary effects, i.e., wage demands, would have got completely out of control, because people would have expected inflation to become embedded, and then they would have demanded higher wages. And frankly, they would have taken their money out of the bank and started spending it. So the velocity of money would have gone up, and you would have got a self-fulfilling prophecy. So I don't think they had any choice. But I agree that the evidence suggests it hasn't had any effect so far.
But of course, the rate of inflation is dropping very rapidly. And if under those circumstances, you would imagine that if this is correct, they can drop interest rates very rapidly too, and inflation won't recur.
That is a very good point. Absolutely.
So in fact, that's how to test the hypothesis, Keith. If they just drop interest rates to 1% tomorrow and then see what happens.
Well, the thing is, they can't do that because wages are far too high.
Yeah.
So, the secondary effects have kicked in. You could argue that they would have been worse without raising interest rates, but there's no way you can have in the UK wage growth of 7.1% and that being compatible with a 2% inflation target.
Completely agree, and that's basically what this slide is saying. And I mean, one of the issues, we talked about this before, one of the problems that central banks now have is that with so many loans being fixed for a prolonged period of time, the transmission mechanism of raising interest rates to counter inflation is really not very effective at all. And a more effective tool is possibly needed in the future to counter inflation shocks, rather than this very slow and not particularly effective interest policy.
We have another tool, Richard. It's called fiscal policy, but that would involve, governments actually voting to cut the budget.
Yeah,
they never do.
Sorry, guys, you can't have that. Oh, well, in that case, I won't vote for you.
Yeah,
that's the problem.
You're the only person in the country, Richard, who would vote for, fiscal rectitude.
So, monetary policy has not been primarily responsible for falls in inflation we've seen over the recent months. The primary cause has been the unwinding of supply shocks. And the higher interest rates have helped contribute to lower inflation expectations, dampening secondary effects like wage demands. And as we have discussed many times, monetary policy works with long and variable lags. And this cycle, it's working with very long and very variable lags. And we know that higher interest rates haven't slowed the economy very much so far, because the economies haven't slowed that much. But they will, as the transmission effects become actually stronger due to the delayed effect, they will have an increasing effect in coming months. So the question is the policy completely counterproductive at this point?
Well, I think you've got to get wage growth down. So you've got to slow the economy and create some slack in the jobs market. So, but we know interest rates are still rising, and the lag effect is longer and longer. Okay, thank you, Richard. On to Inflation Watch, and actually quite a lot of data this week. So UK, we had CPI coming down at 7.9% in June, core down, RPI down, which we've all covered. In Germany, actually, inflation rose. So German June inflation rose to 6.4% and core ticked up to 5.8%.
That's interesting. Well, that's very interesting, isn't it?
Yeah, it's not just the UK.
I mean, the other question is there more than one cause of the current inflation? So supply shocks being one of them, excessively loose monetary policy being the other.
Certainly, they should have raised interest rates much faster than they did to contain secondary effects. I mean, that whole period where they're saying inflation was transitory, and then it most certainly wasn't, helped embed inflation expectations.
Yeah.
And in Japan, inflation also ticked up. So 1 month's data, bear in mind, German inflation certainly fell last month and has ticked up, does not necessarily indicate a one-way fall in inflation. And we should be cognizant of that when thinking about UK inflation.
I'm always very aware of that piece of work that was done by research affiliates, which said that if you've studied past historic inflationary periods, they always take a number of years to decline. They always oscillate.
Yeah. Now, if we look at UK inflation, this is food and energy, and you'll see that actually food prices have generally peaked. So butter, fresh fish, etc., they're all coming down, but the big drops have been caused by energy. Now, that has been a big contributor to disinflation the last few months, but we know that energy prices have bottomed for now, so that is not going to be a contributor going forwards. And if we look at various supply side statistics, well, it does look like UK inflation should continue to come down over the coming months. fingers crossed. The only one that is the exception is UK average earnings, bottom right. That's still way too high. The last charts showed that energy has been a big contributor to disinflation over the last few months. But if we exclude energy, then the picture is much less reassuring. The left-hand chart shows that excluding energy, UK CPI is still very elevated, although it is appearing to start coming down, but we have been here before. Private sector selling expectations are falling, and if the historic relationships hold, that means inflation should continue to come down in the coming months. But the UK still has excess savings from the pandemic, unlike the US. In fact, I thought this chart was really interesting. In the UK and Europe, none of the excess savings from the pandemic appears to have been spent. So consumers still, on average, have excess savings. Now, of course, a lot of depends on the distribution of those savings. If they're all filtered down towards the top of the income group who don't spend, that won't support spending. This reminder, in May, UK average weekly earnings, including bonus, were 6.9% year on year, way above the Bank of England's 2% target. In order for inflation to come sustainably down, that has to halve. And as of May, it was still climbing. I thought this was poor, frankly. So when the Bank of England were telling everyone to restrain wage growth, they were paying their staff an extra 25 million. Not a good look.
Wow. I mean, they're such hypocrites, aren't they?
Well, it's rare I agree with the Daily Star, but, you know, they have a point, frankly.
They are hypocrites.
Yeah. Now, good news in the US is the premium for switching jobs is basically back into the normal range. And that is further evidence that the jobs market there is slowing. And we were talking earlier about US export prices. Well, digital prices are falling, although not at 12% a year, which is what US exports were falling at. And PPI is for finished goods is negative.
It's quite a chunky negative figure, isn't it? Actually, as we looked at it, it makes you wonder where it's going.
Yeah. And rents are essentially flat year on year, although CPI shelter is still at 7.8%, and that is artificially keeping US CPI higher than it should be. And we often talk about the Mannheim used car index. Now, what I hadn't realized is the Mannheim used car index is wholesale prices, and retail prices follow with a 2-month lag. And if you look at the green line, then the yellow line, which is CPI component for used cars and trucks, should follow the green line, and the green line's kept on falling. So the CPI component for used cars should fall further in the next couple of months. So in summary, UK inflation came in soft, and hopefully the supply side contributors to UK inflation are continuing to fall, and that bodes well for further falls in UK inflation in the coming months. However, wage inflation is still way too high. So UK interest rates are likely to rise further when the Bank of England meet again early next month, and stay there higher for longer until we get some slack in the labour market and wage inflation comes down. Inflationary pressures in the US, frankly, continue to weaken, and I really can't see strong inflationary pressures in the US. Recession Watch, Richard.
Thank you, Keith. So this is a chart of showing the number of people in the US who feel that they are disabled, and having hit what looks like a COVID low, there's been a huge spike in the number of people who feel they're disabled. I wonder why.
Well, actually, it probably is long COVID.
Possibly.
But the important point, Richard, is that online there was lots of discussion about how possibly people were declaring themselves disabled instead of declaring themselves unemployed, presumably to get higher benefits. And that is not the case, because this is just an answer to a survey, and it doesn't matter whether you are employed, unemployed, or retired. So
it's self-reporting.
Yeah.
That's 34 million people, though.
Yeah.
10% of the population, or more, 15% of the population.
Mm.
So loan application rejection probability has increased for all types of loans, the black line being the average. And you can see the different types of loan there, with, I think, mortgage loans being the most likely to be rejected. So the chances of your loan being rejected for mortgages is not far off 50%, which means that credit conditions have tightened rapidly since October 2022, basically, where that low point seems to have been. So that is an indication the market that the economy should slow down, as we've been saying.
Yeah.
It's a continuation. Delinquency rate on US consumer loans is still low, but is rising. So it's risen 35% year on year, but the absolute figure is pretty low, and it's risen from a very low absolute figure. So watch this space to see whether it continues to rise.
I don't see how it can't.
And here we have US bankruptcy filings. In June, they're the highest since 2012. UK bankruptcy filings are also high.
Yeah. We've kept a lot of failing companies alive through the fiscal largesse during the pandemic, and rising interest rates is killing them off.
Indeed, yeah. So levels of distressed real estate in US are rising. I mean, the amount of troubled office buildings is enormous, and there have been a few high-profile, the last couple of weeks, a few high-profile well, they have this thing in the US, don't they, where they're non-recourse loans. So basically, the owner of the office building can walk away, leaving the banks holding the bad debt.
Yeah.
So anyway, that's presumably the banks have a charge over the building, but they don't have recourse to the company that owns the building.
Precisely. But the trouble is, the value of the building's halved.
Yeah, the banks lose the money. So credit spreads are not reflecting the real economy. So there we have the white line filings of bankruptcies, which I've just discussed, is rising fast. Credit spreads are not rising. You would expect credit spreads to leap up pretty quickly to protect the issuers of the credit, or rather the funders of the credit, against delinquency. And it's odd that that hasn't happened.
Yeah, no, it's really weird. So we did talk about a while ago how there's been a lack of junk bond issuance. So the junk bond ETFs and funds have kept on having to reinvest interest, etc., new money into existing bonds, and perhaps that's keeping prices low. But this is odd.
But also, that may well be the case, Keith. That is what's happening. But of course, what that is building up is a problem in the ETFs in underpaying for rubbish credit.
Yes.
So this is the likelihood. This is a funny chart. This is the likelihood of coming up with $2,000 within the next month, minus the likelihood of needing $2,000 in the next month. So you're not very likely to come up with it, and you're much more likely to need it. Yes. It suggests there's sort of some financial stress within households.
Yeah.
And it is, which basically means the difference between the ability to raise and the likelihood of needing it is increasing dramatically.
Yeah. So what I take this to mean is that, we've talked many times about the pandemic fiscal largesse leading to excess private savings. Well, this is evidence that the Fed is right, and that all of that excess has been spent by the lowest, by the poorest members of society. And they're worried about needing $2,000 and not being able to find it.
Yeah. Be interesting to see where that chart goes over the next few months. So this is showing that retail sales at US gasoline stations continue to fall. And now it declines last seen in a GFC, i.e. our interpretation of this is that people are buying less gasoline. Two reasons. One would be electric vehicles, which would account for probably a fairly small element of it. The other would people driving less because they can't afford the fuel.
Yep.
Keith, this is a blue line and a green line, and I am blue-green colorblind, and I can't tell the lines apart. What's this chart telling us, please?
So this is the correlation between the Fed's Senior Loan Officer Survey, which is in blue and leads by 1 year, and commercial industrial loan growth. And you'll see actually the correlation between the two is very good, but it implies there's a big lag between banks tightening and loans actually being taken out. The 1 year seems a lot, frankly. But if this correlation holds, then loan growth is going to go deeply negative over the next few months.
That's interesting. So it reminds me of the snooker. For those of you watching in black and white, the blue is the one next to the pink.
Yes. I think that gag dates us both.
It does, doesn't it? Yes. US capacity utilization is starting to fall. I can see that's in green. And it's only just beginning to roll over, but it could be indicative that it's of a slowdown in manufacturing.
Yeah. And the thing is, if they're not using the plant to the full capacity, surely they need fewer workers.
Yeah. And the 4-week average US implied oil demand for gasoline is falling, which is consistent with the retail sales that we were talking about a few slides ago. It's quite a steep fall in 2023, parallels 2019.
Yeah, it's something odd going on there, though. There's just caution that there's over this 4-week period.
Yeah.
In 2023 and 2019, there was this drop, which makes you wonder how seasonal it is, although the 2023 line is well below 2019.
Again, it's one of these things, isn't it, Keith, where you have to watch what happens with data series over the next couple of months.
Yeah.
And the volume of German exports to China reveals the extent of the slowdown in both countries. Now, Germany is very dependent on exports to China and is desperate to try and maintain good relationship with them, which is clearly difficult at the moment for various reasons. And but you can see that there's been a very sharp decline in 2023.
Yeah, in volumes.
Yeah.
The actual values held up due to inflation, but the volumes have dropped substantially.
And they're now back to like 2010 to 2015 levels, aren't they?
Yeah.
Having enjoyed sort of fairly dramatic growth.
And we in the UK have been very jealous of the German economy for years because of their, high value manufacturing sector. Well, the flip side of that is all the manufacturing is A, moving to China, and B, you're heavily dependent on Chinese demand. And the downsides of that policy are now becoming clear.
And there's another problem, which is if Germany does go into quite a deep recession, I'm not saying it's going to, but if it does, it is the country that funds Europe.
Good point. Very good point.
So the Eurozone, coincident indicator. We have an abbreviation there. Since 2000, so you can see that between 2000 and 2020, apart from the GFC and COVID, it basically oscillated between 0 and 1, has fallen dramatically down to about 0.7. So something's going on there. And that, presumably, Keith, this is an amalgamation of a lot of different indicators.
Yeah, but, earlier in the year, we were forecasting a recession. And then there was this big bounce, and which we found mystifying, and we didn't change our tune. And now it's rolling over again.
Yeah. And the Chinese economy continues to surprise some people to the downside. I think I just think that it's to be expected given the issues they've got with their property market, the fact they locked down for the best part of 2 years or whatever it was, caused severe damage to their economy there, and the property issue, which, as a reminder, residential property is 30% of the Chinese economy, and is suffering a dramatic slowdown and huge over-indebtedness. It's not surprising that the City China Economic Surprise Index, or the Chinese economy, is doing badly. And it is doing badly. Although, not if
other people are surprised, Richard, not you.
I'm an eternal pessimist, Keith. I'm surprised when things get better than expected. I'm surprised it's not worse, frankly. So, summarize, US credit conditions still tightening, US defaults are rising, US gasoline demand is falling, indicating a weakening consumer. We've got survey data indicating an increasing proportion of population struggle to meet $2,000 bill. The EU economy is slowing, Chinese economic growth is slowing, and I would chuck in there that chart we looked at earlier, which is the unadjusted US employment figure. It's spiking upwards. And I think that's really interesting.
Yeah. Okay, on to US corporate profits. And actually, this is a plea for help from the audience. So something odd is going on, and I don't understand it. Now, PermaBear, Albert Edwards, posted this chart earlier on Twitter. And what it shows is net interest payments by US corporations in red, and the blue line is the Fed funds rate. Now, you would expect, as the Fed funds rate has risen, and we know corporate debt has risen, that net interest payments by US corporations would also have risen sharply. In fact, they've fallen. What's going on? How is that possible? I don't know either the universe he's using or how he defines net interest payments. I assume that is just the gross interest on the debt. Somebody knows more, please let me know.
It is very strange. Can I offer a couple of possibilities? And one is a lot of US, I don't know the answer, I don't know if this is the case. If a lot of US corporate debt is fixed, then that the effective interest rate rises may not yet have permeated through. And it may be that they're doing issues to pay down debt before they have to repay or they have to refinance. But I agree, Keith, without understanding actually why this is happening, it's tricky to interpret.
Yeah. So if you know, please get in touch. And on to US credit card delinquency rates. And thank you very much to Wayne J for providing a lot of the data in this. Now, last week, we showed you this chart, which is delinquency rates on US credit cards by age group. And it shows that delinquency rates for the prime working age population are rising quickly. And the US banks have reported earnings last week, and all of them reported rapidly rising delinquency rates. You see, delinquency rates, although low in absolute terms, they're up 50% or more in a year.
Yeah.
Now, what's interesting is if you break this down into small and large banks, you get very different pictures. So this is the delinquency rate on credit card loans for banks outside the top 100 in the US. And you'll see that their delinquency rate is extraordinary. That's above 7%. Now, if you go through the numbers, it's really difficult to make a decent profit when 7% of your loans are defaulting. But if you look at the top 100, you get a completely different picture. Only around 2.5% of credit card loans for the top 100 banks are defaulting. And if you look at the charge-off rate, which is simply the amount being defaulted by the amount outstanding, then you get some really pretty frightening numbers. That's about 8.5%. So that implies the borrowers with the largest balances are the ones defaulting. And this breaks it down further. You see that actually, when you look at consumer loans, there has been a small rise in defaults on general loans, but the rise in credit card defaults is quite stark. And looked at year on year, which is always a bit of a cheat, but there's been a very sharp rise in the defaults in the past year. So we know that the US large banks, they've reported earnings, they're doing just fine. But the problems we reported earlier in the year with the failures of Silicon Valley Bank and Signature Bank, the problems are in the small banks, and they are seeing a significant deterioration in the quality of their loans to the US consumer. Now, why are US small banks much less competitive than large banks? Now, Wayne J had some suggestions. Number one, credit card business is a winner takes all or scale business, so that the large banks take the pick of the crop, and everyone who can't get credit cards from the big banks then turns to the smaller banks. So there's a selection bias problem. Actually, that's it, essentially. Or smaller banks are more honest and bigger banks are hiding the delinquencies, which I don't believe. I think there's a selection bias problem going on. But what that means is that that just adds to the problems US small banks are facing. So we know they're having falling interest rate margins due to rising funding costs, deterioration in capital due to mark-to-market losses on their loan and bond portfolios, and they're having and will continue to have rising commercial real estate loan losses. All of that means that the profitability, in fact, the viability of a lot of US small banks will be questioned, and we expect to see further bank failures in the coming months. So the fact that the big banks have reported bumper profits, frankly, does not change our view that the smaller banks in the US are in trouble and a credit crunch is coming. Richard, your favorite subject, the US federal budget.
Thank you, Keith. So the debt, this is extraordinary. The debt ceiling was suspended on the 2nd of June. And in the past 6 weeks, US government debt has risen by 1 trillion or 3%, which is just extraordinary. You look at the shape of that graph, showing the increase in debt since in the last 2 years. So it's risen from 28 to 32.
Yeah,
which is 4 trillion, but that is also something like 12-15% of the US economy increase.
Yes.
What can we say? US federal government spending in billions of dollars. It's $100 billion a month higher than it was a year ago. I mean, these numbers are ridiculous. What is $100 billion? One can't. If you take a 1 meter cube and divide it into one centimeter cubes, like sugar lumps. There's 1 million 1 centimeter cubes in a 1 meter cube. And 1 billion, of course, is 1,000. So you have to take 1,000 1 meter cubes, fill them with 1 centimeter cubes, and then scatter them everywhere and try and imagine that pile of 1 centimeter cubes. And that is 1 billion.
Yeah.
It's just extraordinary. And you do wonder how it's all going to end.
Yeah, you do. Yeah.
It can't, well, my view is it can't end well. And it's almost like they're going for a last hurrah. So federal government receipts down 7.3% year on year. That's having increased debt in the last 2 years by 4 trillion. We know that the interest to be paid on US government debt is going up. There may be some reason delayed tax payments due to winter last year.
Can I come in here, Rich? This is odd. We've talked about this before, but normally you only see falls in US tax receipts during a recession, and we know that we're not in a recession. So they're down 7.3% year on year. What's going on? Now, the best explanation I can find is that there were winter storms last year, and the afflicted regions were given additional time to file their tax returns. And so therefore there may be a delay effect, and those tax receipts will come in, but they'll come in with a lag. And that means that there's this immediate fall, but it will be made up for later. It's still odd.
Possibly so, Keith, yeah. Cumulative fiscal budget deficit in billions. It's the third largest. The annual deficit is the third largest in history. And in 2023, it is at 3 trillion.
Yeah.
It's heading for 3 trillion. Anyway, it's just an extraordinary. Of course, a lot of the expenditure is the Inflation Reduction Act and reshoring, and presumably the US government is hoping to recover some of that in increased economic activity and tax receipts in the future, but it just feels like it's unsustainable. So year-to-date federal debt interest payments, 652 billion, annualized at 1 trillion, and which is 3% of the economy.
Yeah. Well, this all makes sense. If you got 30 trillion of debt, 32 trillion of debt, and you got 3% interest rates, then you're spending 1 trillion in interest.
Yeah. So slightly complex chart here. The current average interest on outstanding US federal debt is 2.8%. If US interest rates stay higher, this will rise. And at 32 trillion fiscal debt, an average rate of 4% would mean an interest bill of 1.3 trillion, making interest. So, basically, the US government has to get its interest bill down.
Yeah.
Well, it doesn't have to, because the Federal Reserve can print money to fund the interest on debt, which by some accounts is actually what it's been doing for the last 10 years, and which it will probably continue to do until it can't. US interest payment on federal debt versus defense spending. Well, it's eclipsed defense. That looks like a Patriot missile.
Yes. Well, so the last table was the fiscal year 2023. This is annual. So the last table was to presumably April, and now it's eclipsed defense spending. And
US federal debt service costs, they are unsustainable, and interest rates have to fall, or the Fed will have to print in order to absorb the interest rate costs. QE.
Well, one thing I'd say, Richard, is it's also a function of interest rates. And so actually, when you look at US interest payments as a proportion of its tax income, then actually it has been higher. It's been, back in the mid-80s, they were spending 50% of tax income on interest payments. But as interest rates came down, so did their interest bill. And so that's one of the reasons they need to get inflation under control, is to get the budget under control.
I think the problem here is with that graph is that we've only recently entered into this high interest rate regime, and the interest bill is spiking incredibly quickly. So if we remain in this regime, it's going to go up very fast. Whereas if interest rates fall quite quickly, then it'll look like a little spike historically. Treasury posted a 228 billion June deficit, in part due to a 52 billion bill for rescuing failing banks, which, if you remember, many of which are failing because their investments in government debt have gone bad with the increase in interest rates.
Yeah.
It's a bit of a vicious cycle, of course. And if this is, in fact, a sense of purchasing your own debt.
Yeah, these numbers are just really extraordinary.
Yeah. So the budget deficit forecast to be 5.4% of GDP in 2023, with a primary deficit of 2.9%. So those two deficits, the gap is widening, and they are both increasing. Although the primary deficit hasn't increased to the extent that the total deficit has increased.
You see, I found this really interesting, because we have been talking previously about how irresponsible Biden's been in spending the fiscal deficit being completely out of control. But actually, a lot of that has been the rise in interest payments. So actually, the primary deficit is bad, but it's not catastrophic. And remember that the Trump corporate tax cuts, I think they're due to unwind in 2026. And actually, the primary deficit is not too bad. If you could raise taxes by 1.5%, you would get that back under control. What the problem is that interest payments have completely blown out. Now, if you therefore get inflation under control and interest rate expectations down, then actually the US budget starts to look more sustainable.
Well, there's an argument, isn't there, going around that we look at interest and debt the wrong way around, that actually the reason interest rates have fallen is because there's so much debt, not the other way around. And this data here suggests that argument may actually be correct, because there is so much government debt that they can't afford for interest rates to be high. Therefore, interest rates have to be low, and the government has the ability to influence that. So we may actually be seeing overtly that the government is managing interest rates down to make its debt affordable. Clearly, that hasn't happened over the last year or so.
No, I believe that, Richard. In the wider economy context, I just don't think that you can have high interest rates with very high debt levels, because as those debts come to be refinanced, even if they're on short-term fixed, when they come to be refinanced, the interest bill just becomes unsustainable. And so you then either have a solvency crisis, or you have to have interest rates come back down as highly indebted borrowers cut back their spending to afford their higher interest bills.
Yeah, no, I agree, Keith. It is unsustainable. So we have a nicely enunciated bottom line here, which basically is the sharp rise in US federal deficit, primarily due to rapidly rising interest rates. The forecast primary deficit for 2023 is 2.9%, which is high, but is not totally irresponsible by historic standards. And according to the Kelechi-Levy formula, corporate profits are a function of government deficit. And the high US budget deficit this year supported the economy, supports US corporate profits, and will therefore support US corporate tax payments. So as interest rates fall, which we do expect them to do, the budget deficit should fall, and that would mean the sustainability of this level of debt is better than you would see on the surface. But the path of US debt looks unsustainable. The rate of growth of US debt looks unsustainable.
Completely agree. Okay, now new section, soft landing watch, because everywhere the market participants seem to be expecting that the US economy is going to make a soft landing. Now, if we look at the Citigroup Economic Surprise Index, it remains very strong. So the US economy is outperforming expectations, although the Bloomberg Economic Surprise Index took a bit of a bath last week, and expectations can change quite quickly, I would have thought.
Yeah.
Now, we reported earlier the headline Philadelphia Fed Manufacturing Index, and reminder that each Fed area produces its own index, so we don't report any of these in depth. But if you looked at the Philadelphia Fed expectations index, i.e. what manufacturers were expecting conditions to be in 6 months' time, then, and that's the orange line, it was pretty positive. So their current conditions index was poor, but they're expecting things to get much better in 6 months' time. And that matters, because if manufacturers expect conditions to get better, they're not going to lay staff off. And that becomes a bit of a self-fulfilling prophecy, in that those retained staff can keep on spending money and it supports the economy. What happens, though, is that during that period when orders are poor and activity is poor and you're keeping on the staff, corporate profits should fall. And good news for the US economy is that workers are receiving real wage rises for the first time in 2 years. And that should support US consumer confidence. And is it any coincidence that US consumer confidence has ticked up last month? This is weird, in that we know delinquency rates have gone through the roof, but credit card users are paying off much more of their outstanding balance each month. So perhaps the period of the pandemic allowed US consumers to get ahead of their debts and to try and keep ahead of them. Now, junk bond spreads are at their lows, and one way of looking at that is that the market is suggesting that there's not going to be any sort of default cycle, although we know there is. So the other way, our way of looking at it, is this is insane and a sign of market overexuberance.
Yes, malinvestment.
But recessions tend to start when corporate cash flows are negative, and in part due to fiscal largesse, they ain't. They're still solidly positive. So no sign of recession in corporate earnings as yet. And a weak dollar, and the dollar's been weakening, is very good for the US economy and US manufacturing. And the dark blue line is the US currency inverted, and the light blue line is ISM manufacturing. If the historic relationship holds, then US manufacturing should start to recover in the coming months. But that assumes that the rest of the world is doing okay and wants to buy cheaper American manufacturers. And new orders relative to inventories, which is the light blue line, appears to have bottomed. And that means that as retailers run down their inventories at some stage, they're going to have to reorder. And that should also support US manufacturing. And fund managers think the overwhelming likelihood is we're going to get a soft landing. Goldman Sachs thinks that the US economy will face a drag from student loan repayments starting in September, but the growth impulse from financial conditions and bank lendings is mainly behind us, and growth can start to improve from here. And they're forecasting that growth will improve in Q3 and Q4. The Economic Cycle Research Institute's weekly leading index has turned strongly positive over the last few months. So, bottom line is the US economy certainly continues to show resilience. And I think what you can say is that consumers and corporates are increasingly optimistic about the future, and expectations matter. However, I think a lot of that optimism is simply a function of the strong stock market. So let's wait and see. If manufacturing starts to recover, then yes, we could get a soft landing. But it's very difficult to see how you get a soft landing when interest rates are continuing to rise, and we know they work with long and variable lags. And we also know that credit conditions are tightening, and those effects, so the fall in loan growth and credit, will increasingly affect the US economy in the second half. On to other charts, Richard.
Thank you, Keith. So asking rents in London are 28% higher than before the pandemic, at an average £2,567 per month. And that is a record. So what a time to be a renter in London.
I mean, I was absolutely flabbergasted by this. That's the average. So it's just extraordinary. So the average rent on a UK property, a London property, is 30 grand of post-tax income.
Yeah.
How does anyone live in this city?
Well, I think that property rents roughly rise as a proportion of income. So there's a point, isn't there? We're talking about averages here. So people can afford a certain percentage of their income, their post-tax income, on rent, and then no more. And I think property rents always rise to hit that level. I don't actually know what 30,000 equates to post-tax, because you don't know what the average renter is earning. But I suspect the average renter is earning more, and therefore the rents are still just about affordable. But it is extraordinary. And the number of flats that are being built in London is also quite extraordinary.
It is, yeah.
Vast numbers of flats going up in London.
But again, I would have thought that with the rise in remote working, that you just move out to Surbiton and commute in once a week.
Yeah, I agree. I mean, it's extraordinary amount of money. I mean, maybe the number of available properties is falling. Then you think people will be buying them. This is a chart, isn't it, that sort of shows that people are slowly starting to think that maybe we shouldn't have left the EU. Well, actually, not slowly, but in increasing numbers. Yeah,
I'm going back to that chart of UK income growth.
Yeah, and national depression.
Yeah. So
since the GFC, the US economy has massively outperformed the Eurozone. So it is now third larger.
That's extraordinary. So I saw this on Twitter and I couldn't believe it. So I had to go and look it up, from an independent source, but it's right. This is extraordinary.
It is, isn't it?
And we know the UK economy has also done very poorly since the great financial crisis. So what is it that's allowed the US to keep on growing when we have stagnated?
Oh, I suspect two things. I suspect regulation.
Yeah.
I suspect that because the US has this huge advantage in that it owns all of the world's largest tech companies.
Yes. And which are essentially monopolies, like Microsoft. Essentially, you have to pay, don't you?
Yeah, exactly. And the whole ecosystems that form around those that are mostly US based. And the TGA account has been rebuilt with little effect on the markets. So rebuilding the Treasury General account, which ran down, coming up to the debt ceiling, has been rebuilt substantially. and nobody noticed.
Yeah, nobody noticed because the Fed didn't manage to do what it hoped to do, which was simply swap money from the repo market, which is money the banks have already deposited with the Fed, to the TGA account.
And the ECB balance sheet is continuing to shrink, and it only owns 53% of Eurozone GDP, bonds to the value of 53% of Eurozone GDP, which is a piffling amount. Yeah.
Well, those are actually quite big falls.
It is a big fall, isn't it? Yeah.
But 53% of Eurozone GDP.
But if Germany goes into a recession,
yeah,
then I think it is in a recession, isn't it? But if it has a nasty recession,
they'll buy it all back.
Yes, exactly, and more.
Yeah.
Chinese real estate sector continuing to struggle. China Evergrande has announced losses of 81 billion over the past 2 years. Now, we made it on this about a year ago, if I remember correctly, Keith. We've sort of slightly got off the news, haven't it? We've got bored with it. But basically, the Chinese residential property development sector is in big trouble.
Yeah. And I remember we covered in the early days of the podcast when China Evergrande was doing a 10 billion offshore dollar bond, and we were saying that you'd have to be absolutely insane to buy that. Well, we were absolutely right.
We were. And Chinese companies have been reporting big drops in profitability. If you look down there, have a look in your own time, but you can see that there are chunky drops in profitability going on there, all indicative of a slowdown in the Chinese economy. And Chinese high-yield dollar bonds plunging after state-backed developer Greenland Holdings defaulted. That was just last week, wasn't it? And so everybody's trying to get out of even state-backed developers. I mean, the Chinese property market is in trouble and will have to undergo a serious correction. It's going to have a seriously big impact on the Chinese economy.
Okay, and after all that, you need some good news. Well, this cute little fella is a Swift, and this is a brick, which is actually home for a Swift. And various councils in the UK are now mandating them to be put into homes. So there you go. Good for wildlife.
That's rather nice, isn't it? And they're a delicacy, I think, aren't they, Keith?
Well, that's right. We destroy their habitat by, ploughing up their fields, but we put in one of these bricks and we feel better about ourselves. Sorry, this was meant to be the good news section, wasn't it? Moving swiftly on. Equities, Richard.
Oh, thank you, Keith. Equities.
Well,
so the FTSE All World Equity Index had a good week, up 3.4% for the week, 14.5% for the year.
Yeah, good, actually.
Quite a good run, hasn't it? FTSE All Share Index had a decent week, but hasn't had a great year. It is still flat, as it has been for the last 20 odd years. The stocks, Europe 600, a decent year-to-date change, a little bit of a bounce this week, and it's been flat really for the last 5 months or so.
Yeah, I still find this absolutely extraordinary because we know the Eurozone economy is not doing well.
No, one would expect it to start to fall.
Yeah, and interest rates are rising quickly. Economy is not doing well. Why on earth are equities up?
Yeah, agreed. The S&P 500, well, there we are. As we're waiting for it to hit, I don't know, about 20,000, aren't we, Keith? According to that chart you showed earlier.
Yes.
But it's a small increase, disappointingly small increase for the week, I'd say, up 18% for the year.
Yeah, but the linear rise is still intact, I'd say.
I say, yeah. And the NASDAQ had a very poor week, but up on an annualized rate of about 70%. And the weight of the 5-10 largest stock in the NASDAQ 100 since 2000. So the NASDAQ has been rebased on Friday rebalanced on Friday to reduce the weight of the biggest stocks. So they dropped it back down to 50%, basically, from 60%.
Yeah. Something you should be aware of if you've got an ETF or whatever in NASDAQ 100, we report the NASDAQ composite, which has got far more than 100 stocks in, I believe.
So topics up 0.8% for the week and nearly 20% up for the year, looking jolly healthy. Bitcoin down 4% for the week, but still up 81% on the year.
Amazing.
And the pound had a reasonable year, up 6.3%, but was down 2% last week, I think, as the dollar index. The dollar index generally bounced back a bit, didn't it?
But also UK rate expectations came down, so sterling fell.
Yeah. And the euro also down against the dollar for the week and up 4% year to date, which means the pound is up against the euro year to date.
Yes, but given what we know about French grocery prices, we need it.
Yes. Yeah, I was going to say it makes our holidays cheaper, doesn't really. And then we have the dollar index, which has fallen below 100 for the first time in ever, actually, I think, didn't it? But it's now bounced back up a little bit. And United States, the VIX is still extraordinarily low.
Yeah, amazing. Lots of complacency is what I read that.
Yeah. And the fear greed index market is still in extreme greed, where it spends most of its time these days.
Yeah. Carrying on, the NASDAQ did have a poor week, but this updated this morning, was stuck in extreme greed.
Yeah. And the S&P 500 is now 5% above the level when the Fed started raising interest rates, which is so counterintuitive.
Yeah, absolutely. I mean, the discount rate for corporate earnings has risen. Surely equities should be falling. It's extraordinary.
Yeah. And we're asking the question, is this a bear market rally? And if it is a bear market rally, then it's been a jolly big one.
Yeah.
But if the jaws close, it's going to be a 20% drop from here.
Yeah. I just don't see it. Unless you get a soft landing. And we talked about this last week. Corporate earnings would then need to rise well above their long-term trend into totally uncharted territory.
Yeah.
I just can't see it.
I'm with you, Keith. But I'm not betting on it. So the equity rally has been fueled by a bear squeeze. I mean, you can understand that, can't you? Because the bears have really been beaten up. And if they're getting out, then obviously that is going to cause the market to go up as they close their short positions.
Yeah.
We have a big inflow into equities in June. So pushing the market higher. And strong tech inflows in the last 8 weeks, possibly partly due to AI, although that news may be a bit older than 8 weeks now. But I suspect AI is still having a big impact on it. And long big tech is by far the most crowded trade. Everybody's long tech.
Yeah. So the other way to look at that is who else is going to buy, when it's that overweight.
What's this one telling us, Keith?
Well, we've talked about how everyone is optimistic about equities. Well, the people who are not getting carried away are fund managers. And this is the fund manager survey. And their cash level equity allocation is low. They're not expecting much growth. They're not buying into equities.
The strong first half gains suggest historically that more moderate but positive returns are ahead, although this market doesn't really conform to, norms.
Yeah, well, I agree.
And Wall Street analysts forecasting more difficult second half. I guess, given that it's up nearly 40% in the first half, you've got to, haven't you? And it's not surprising, you would expect. Yeah. And we've got the concentration higher now than we had during the tech bubble. So basically, this is being driven by those big tech companies.
Well, the thing is, I don't think you're really comparing the two. And that the thing, as you were talking earlier about US exports, Google and Microsoft, they're really monopolies.
Yeah.
And they're not speculative companies. They really, they make so much money, and there's no reason to expect that to change going forward.
Yeah, I agree. Funny old world. So US, so this is the big seven are predominating the market, but even as their earnings fall year on year. So multiple expansion and profit margins across the board are still strong. They've fallen, but they are strong at 10%.
Yeah.
And the percentage of unprofitable companies in the Russell 2000 is 45%. And it's risen from 20% in the year 2000. There's a lot of unprofitable companies with a lot of debt, but as we know, things aren't playing out quite as we expected them to yet.
Yeah. Well, thank you to Joy for sending us this. So this chart shows regression between the subsequent return of the S&P 500 in excess of Treasury bonds and Hussman's model. And what they're saying is there's a good correlation between their model and future returns. And their model is forecasting that S&P 500 is going to underperform Treasury bonds over the next 10 years by 7.2%, i.e. equities are overvalued versus bonds.
And earnings revisions are starting to rise again. So analysts getting a bit more optimistic about earnings, future earnings. And now 80% of the stocks in the S&P are above their 50-day moving average. So we have the rally is broadening out to all stocks. Investment sentiment is very bullish. You can see from the orange chart. And although it's extremely positive, there's no reason that it will change anytime soon. It can stay very positive for a long, long time.
Yeah. Although, frankly, I don't think we're in the sort of situations we've seen before where we've had long positive readings. You need a strong recovery in the economy for that to be the case.
That's true. And analysts, we've had earnings revisions upwards, analysts expecting earnings to start growing again in Q3. We shall see.
Yeah, we shall see. Deeply skeptical. I've been saying that for a while.
And this is a chart that appeals to Keith's prejudices, which is showing us what, Keith?
Right. Well, the blue line is the confidence of the smart money. The red line is the confidence of the dumb money. I don't know how they measure this, but I like it. We're obviously the smart money, Richard. Yeah.
Because we have no confidence, Keith.
Yeah, exactly.
I'm sure we're right. And UK smaller companies are underperforming, and basically they if people don't invest in them, then they will inherently underperform. People really aren't particularly interested in investing in UK small caps.
Yeah,
so performing well.
I thought this was an amazing chart.
Yeah, it's not good for the UK economy.
No, basically nobody wants to invest in them.
Yeah. VIX seasonality. Well, we're doing okay, really, aren't we? Apart from the odd blip, we would expect the VIX to start to climb now.
Yeah,
which would imply the S&P starts to fall.
Yeah, this I thought was an important chart.
Mm.
You know, we're in the dog days of summer, not much is happening. But then we get into the traditional September-October crash period with the S&P 500 overvalued.
Yeah.
Right, on to commodities. Thank you, Richard. And energy commodities. And generally, actually a pretty good week for energy, although oil, having had a good run, came down slightly last week. So Brent was down 1.3%, down 6% year to date. WTI down 0.8%. But you'll see that it's been bouncing back last few days. And is the new trend of rising oil prices intact? Question mark. Some numbers specific to the oil market. Well, We had drawdowns in the US after big builds last week, and over the course of the year, we have had net builds, and we showed you charts earlier showing declining US oil consumption. So that would tend to suggest we will see builds in the coming months. US crude production was stable at 12.3 million barrels. The Baker Hughes rig count continues to fall and is down a lot, down 15% year to date. Now, this is a chart of Iranian oil exports. And we know OPEC Plus have been talking about production cuts. Well, Iran has been increasing its exports and selling oil from storage. So its storage, floating storage, has been falling. And talking about oil demand, about 8 to 10% of oil demand is for jet fuel, and the 11th of July was the busiest day in aviation history, with 135,000 flights in the air on that day alone.
Wow.
So, yeah, people want to travel post-COVID.
Yeah, extraordinary.
Now, turning to natural gas, well, this is EU natural gas. It was up 6% on the week, but still low and down 63% on the year. UK also rose, but still down 60% on the year. US natural gas seems to have found and bounced off a bottom. So up 6.7% on the week, so down 40% year to date. Coal also had a tiny bounce, down 66% on the year. But coal's not going away. China is permitting 2 new coal power plants every week last year. Uranium, well, having come off its peak, it's consolidating. Is it going to start climbing again? Up 14% year to date. Industrial metals, Richard.
So we've got aluminium, which is down 3% for the week, down 7% for the year. Cobalt, unchanged on the week. It has really stabilized for the last few months. Copper has failed to, it had a bit of a bounce up to nearly 4, but it hasn't managed to sustain it, and it's dropped back down to 3.8. So it's not reflecting yet any upsurge in the economy. It is going to be in structural deficit. I think it's a question of time. Chromium sort of stabilized now for the last few weeks, down 10% for the year. Iron ore at 100, up 4% on the week, but really unchanged on the year, not suggesting any particular change in demand.
Yeah.
With China continuing to slow down, I suspect the demand for iron ore will fall. Lithium, consolidated now for a couple of months at that price.
Yeah.
There's plenty of demand for it. Neodymium, really, again, it's been consolidating since May, down 40%, over 40% on the year. Nickel, they've all been consolidating for the last couple of months, basically, haven't they, Keith? Down 30%, no change on the week. And tin, 15% up in year to date, but no, and then 1.8% down on the week. That's one of the few ones that's got sort of consistent rise since March. Ferrovanadium, basically gone nowhere since May, down 12% on the year, no change on the week. And zinc, pretty much the same, down 20% on the year, down 4% on the week, but fairly consistent since May. So I'd say industrial commodities are just sitting there waiting. They're not going anywhere. Industrial metals. Precious metals. So gold was up nearly 2% on the week and 7.6% on the year. And,
actually, I think this is quite a good performance, given that we know the dollar strengthened as well. Yeah,
I think gold is definitely consolidating at the sort of 1900 to 2000 level. Silver, always very volatile. down a little bit on the week, slightly up on the year, nearly 3% up on the year. And as we know, silver is required for the electrification of the world, and there is a massive supply deficit. So you would expect the price of silver to move upwards over the next few years. Platinum down 10% on the year, down 0.6% on the week. Rhodium just had a really rubbish year, down nearly 70% on the year and down 7% on the week.
Yeah, that extraordinary spike a couple of years ago seems a long time ago now.
Yeah, makes you wonder what it was. And then palladium is down 28% on the year, a little bit up on the week, but basically it's gone it's gone down a lot.
Yeah. Okay, thank you, Richard. On to rates. Now, good news. So UK inflation came in soft and the whole yield curve shifted down. So the dark blue line is the yield curve as of Friday. The dotted green line is a month ago. So finally, the UK yield curve is below where it was a month ago. What is interesting is that despite inflation coming down in the US, over the course of the last month, the yield curve has actually shifted up, which is odd. So the implication would be that the market is now expecting US interest rates to stay higher for longer, despite inflation surprising to the downside. So they're expecting real interest rates to be substantially higher going forward. Now, the yield curve, 10-year minus 3 month, continues to forecast a coming recession in the US and is the most inverted it has been in the last 40 years. So this chart goes back to 1982. And we look at the differential between optimism, investors' optimism over stock prices and bond prices. Well, they favor stocks at record levels. So as a contrarian, time to switch to bonds, I would say. Now, the rise in the treasury yields over the last, year, have come despite long-term inflation expectations remaining stable. In fact, coming down over that period, which is surprising. So the market is expecting real interest rates to rise. But within that, it's expecting the Fed to start cutting interest rates as soon as January next year. So when we talk about the prospects for a US soft landing, well, if they have a soft landing, presumably labor markets stay tight and wage inflation stays high, and therefore the Fed struggles to cut interest rates. So I think the market is trying to believe several contradictory things at once here.
Yeah.
The market is pricing in a 99.2% chance that the Fed raises rates next week, and we are expecting that to be the last interest rate rise. Now, historically, bonds tend to start outperforming after the last Fed rate hike, and longer duration bonds do better than short duration bonds. Okay, some charts. UK 2-year rate expectations came down sharply following that miss for UK CPI. 10-year also came down, as did the 30-year, although still a long way off where they were just 3 months ago. This is the US 10-year. down from its peak, but still very high. German 10-year not really going anywhere despite German inflation. Sorry, despite European inflation coming down, German inflation, as we saw, actually ticked up last month. This is Italian 10-year, stable, not rising like the German 10-year bond yield is actually rising. Greek doing very well. Any change to your views, Richard?
No, not at the moment, Keith. No. How about you?
Actually, I would reduce my cash and start putting more into bonds. But as you know, I've been doing that for months anyway. It's just now is the sensible time to start putting that trade on rather than when I actually did it.
Well done.
Concluding comments. Well, UK inflation is falling, finally, as we have been forecasting for a while. We said that UK inflation would follow inflation in other jurisdictions down, and it has started to do so, although wage inflation in the UK has not yet peaked and is still way too high for the Bank of England's 2% inflation target. Bottom line, Bank of England needs to continue raising rates and keep them higher until it creates some slack in the UK economy, and that means an economic slowdown. In the US, the economy continues to show resilience, and there was a big bounce in US consumer confidence in July. But if you look at retail sales and the default rate on credit cards and consumer loans, well, it is rising. And we are expecting that tightening credit conditions and rising interest rates will slow the US economy in the coming months. The EU and the Chinese economies are slowing already. Richard, what did you get up to this week?
Well, Keith, I'm going to surprise you by saying nothing. I haven't done anything. People know that I'm invested in precious metals, industrial commodities, and my portfolio has had a sort of reasonable uptick in the last couple of weeks because precious metals have performed quite well. But I think I'm probably going to report my portfolio once a month. So no changes, nothing to report, and I'm sitting on my hands, and I suspect it's going to be a quiet summer now. Yeah. How about you, Keith? What have you been up to?
Thank you, Richard. Well, I had a good week, but not as good as I would have liked, given the fall in UK inflation, but I made back 3.7%. That takes me down to only down 5% this year, which is a bit shit, but, nowhere as bad as it was a few weeks ago. And I added to my bet by selling some short-term gilts to add some more duration. And frankly, I'm pretty much all in now, and I'm not going to be adding to it. Now, something interesting happened this week to TR24, the short-term gilt we have been covering a lot over the last few weeks, in that UK inflation came in soft and interest rate expectations therefore fell, but the price of TR24 also fell. Now, that's revealing, because what that means is the reason TR24 has been falling recently is that the market is actually expecting weak CPI numbers, weak RPI numbers in the UK between now and when the bond matures next March. Now, that's quite interesting. And this is T68, where I've got a big position. And just a reminder, this is its long-term chart. It was issued way back in 2013. And its price hit a peak of 330. Its price is now 78, having hit a low of 70. And once inflation comes back under control, where do you think it normalizes? And where do you think it peaks? You could see it peaking at 150, 175 if we get inflation back under control, there's a recession, and once again, we get deflationary fears. And reminder that the market is an emotional beast. It extrapolates recent data to create a trend. And so the reason we've got down to these levels is the market was expecting UK inflation to be very bad. And so we've had a tick up and the price has recovered. Now, we've seen that actually now quite strong deflationary forces that are offset by high wage inflation. If we can get wages under control, then frankly, I think we go back to the world we had before the invasion of Ukraine and the pandemic. And like Richard, I'm now intending to sit on my hands for a long period, which will make this section of the podcast a gripping view. You have been warned.
Thank you, Keith.
Okay, well, thank you all for watching. Reminder, we are in the disrupted summer schedule, but we will be getting something out this Friday. And thank you all for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.